Good morning, it's Jeffrey Christian. It's Tuesday, the 12th of July, around 9:15 here in New York. I wanted to talk about, I wanted to respond to some of the questions and comments that we've gotten in the two videos last week. We focused on investing and how to invest wisely. And we've gotten some good comments and some questions and some less than good. But I wanted to sort of respond to some of the questions and comments about investing wisely, our track record, and how to go forward. Before I do that, a word on a couple markets. Last week, CPM Group issued a sell. Our short term trade recommendation for gold was to sell with a target of 1820. It got down to 1821.60 this morning, which is in our margin of error, so we're there. We had a sell recommendation on silver with a target of around 1870. It got down to about 1863 this morning. We will be issuing new trade recommendations probably this morning, and they probably will be to maintain that sell position. I just don't like standing in front of a train that's moving really fast, and I think that right now that's going on. A couple words about a couple other markets. Oil, oil is trading around $99, and it's kind of stalling out, as is gold and silver. So, but let's put oil in perspective. $99 is still a very high price, but it's $25 below the peak of $124 for West Texas Intermediate crude that we saw on June 7th, a little bit more than a month ago. The oil price, which has been monopolizing people's attention, if not their intellect, is off 20% from its peak a month ago. And if you look at the oil price, it was trading between $65 and $82 a barrel back in September, October, before it started rising. And yes, the oil price rose long before Russia invaded the Ukraine, and Russia's invasion of the Ukraine was only an added fillip into the upward pressure on oil prices. Oil prices were rising for a bunch of other reasons, very specific to the oil industry and to the global economy. And they started rising in October of last year from a base of around $73 a barrel. So they went from 73 to 124, and now they're 99. What does that mean? It means that half of that spike in oil prices over the last 9 months has been given up. So skyrocketing prices have stopped skyrocketing so far. We're still at risk across the economy and with oil. Now, the other market is the US dollar. Really don't have a lot to say. We have been telling people that the dollar is not collapsing. We've been telling people that the dollar is more attractive than a lot of other currencies, and we expected it to rise on an exchange rate basis. Our sympathies go out to those people who have been listening to the steady, emotional, irrational drumbeat that the dollar was about to collapse rather than rise. They should have studied the market more objectively. They should have looked at the way currency markets work. There's no global reset on the horizon. There's no imminent collapse of the dollar. The US economy is, for all of our warts, the US economy is in better shape than the European and Japanese economies and the UK economy. And those are the major liquid counterparties, currencies to the dollar. So the dollar has strengthened in what people should see as a normal, reasonably expected way, and it should stay strong. Now you're hearing people, oh, well, the dollar is now at parity against the euro. This is spelling a lot of trouble for the global economy. It's nonsense. The dollar got down to 85 cents to the euro many years ago, and the world didn't collapse. The dollar was below parity against the euro for a long period of time, and the world didn't collapse. And the dollar at parity today, problematic for countries that import things from the United States. It's positive for the United States in a number of ways, both in terms of the costs of imports, but also in terms of the foreign direct investment into the United States, which is more costly for the foreigners, i.e. more profitable for the people selling those assets. So don't sweat the dollar. Now, last week I showed these 4 charts. These were CPM Group's intermediate term gold recommendations since December 1980 when I started keeping record. And I went through our gold and silver intermediate. This is like if you are an investor and you say over the next 1 to 3 years, Jeff, should I be long or short gold? These were our buy and sell recommendations. And you can see, yes, in November of 2000, we issued a buy recommendation. We didn't get rid of it until the 4th quarter. Well, officially published report was in like January 4th of 2012. But we had been telling clients, you know, hey, this is the peak, starting in September, October of 2011. We issued a buy recommendation prematurely in 2013 when the price fell to about 1280. And we have that buy recommendation in place still. So those were our recommendations. And for all of those strange people who say that I'm a bear on gold and silver, you'll see my silver chart in a second. What are you looking at? Who are you listening to? You know, or as my high school Russian teacher used to say, what are you on? These are our gold recommendations. These are the returns compared to, say, I'm just going to buy it in December of 1980 and hold it, in which case you probably would have more than doubled your money from what was then $600 an ounce or so to the current price. If you had bought and sold, you'd have had about a 12,000% return. Pretty good, pretty good. Silver, very similar pattern. Again, you'll see that we issued a buy recommendation in silver around 2001, a little bit later than gold. And then we reinforced it around 2005. We've reinforced it all along, which is what we do. We issued a sell recommendation at the end of April of 2011. We issued a buy recommendation around 2019. So again, for all those people who say that I'm a bear on silver or that I'm constantly talking it down, what are you on? Don't answer that. Not to me, at least. You can go to your priest or your psychologist and ask and answer it to them. And again, our returns. So some people actually listened to me last week and said, wow, those are really good returns. And if you look at it, it's a total of about 26 buy and sell recommendations over a period of 41 years. So this is not actively trading back and forth. CPM Group, and you know, to answer some of the questions, and we had some questions here. We'll get to those in a second. To answer some of the questions before I answer them, yeah, these are physical, unleveraged, forwards for shorts positions. These were not leveraged positions using futures or forwards on a leveraged basis. This is an unleveraged physical buy and sell return. Obviously, if you had used leverage contracts, it would have been much better, which is why some people live in mansions and some people don't. Right? Now, Crypto Bear said, of course, their predictions are 98.5% correct. They're the ones that manipulate. You know, if you still believe that silver markets and gold prices are manipulated beyond the spoofing that occurs across all markets, including guavas at your local grocery store, well, you know, you've got bigger problems and you probably shouldn't be managing your own money. By the way, our projections for prices do not have in them any manipulation or conspiracy. They're based on the real gold market, the real silver market, supply, demand, investment demand, inventories, which are enormous, above ground and below ground mineable reserves and resources. And then Mark Brophy said, unless you have past recommendations, you can't verify their claims. I've never seen any investment advisor give access to past reports. Well, Mark, you're dealing with the wrong investment advisors, okay? CPM Group's past recommendations on those charts are all published. Many, if not most, were in CPM Group's yearbooks, and those are available from 1987 to the present at the Library of Congress, a complete set, the New York Public Library, and Baruch University. You can go, if you have access to those libraries, and read all of those. Others were available in the Precious Metals Advisory, or in special reports that we did, or in speeches that we gave. Most of them are in our files. Some of them, especially from the 1980s, especially from when I was at J. Aron and Goldman Sachs prior to 1986, are lost to time. When we became an unwitting beta tester for Windows in the late 80s, early 90s, after Windows started working, we started keeping electronic copies. And all of that stuff's available. And we have had people, clients and would-be clients, actually pay to come in and look at not only the yearbook buy and sell recommendations, but the other recommendations that, for example, occurred in the Precious Metals Advisory on the 4th of January 2012, or in a special report, special market commentary or alert that we did at the end of April 2011. Those things are available, and we can make them available to you. So if you don't believe that we have the track record that we have, you can prove to yourself, and we'll help you prove to yourself that you're wrong. Right? That's a couple questions. Bobby Howard wrote, I know why they're important to you because you make a commission, blah, 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 blah. Well, I'm not sure who they are or what they are that he's referring to, but CPM Group does not earn a commission on anything. We are not a brokerage house. We're not an investment bank. We don't earn commissions. We are a consulting company. We earn research fees. People pay us to help them either make money or save money or protect themselves from adverse price moves in commodities. And they pay us a consulting fee the same way they would pay a lawyer, an accountant, a psychologist, somebody testing their groundwater. We don't earn commissions. And in fact, we structure our consulting fees so that we don't earn more if our clients earn more, unless it's an asset management program where we have profit sharing with them. But we work very hard to align ourselves with our clients' interests and to avoid potential and real conflicts of interest. And if you look at our sponsorships that we've had in our gold and silver and platinum yearbooks since 1996, when we started accepting sponsorships, we've worked very hard to have producers, processors, intermediaries, and users of these metals as our sponsors so that we have a full complement. In the late 1980s, when we were just setting up our gold, silver, and platinum yearbooks, which were called surveys back then, we tried to create a sponsorship program for the Silver Survey using COMEX, the Silver Users Association, the Silver Institute, the London Bullion Market Association, which was just being formed back then, and some other groups. The COMEX pled poverty, and in fact, they were teetering to the point where they actually sold themselves to NYMEX within a while. The silver users expressed some interest, but they weren't really ready to move. The London Bullion Market Association said, quote, We would never sponsor a report that was published out of New York and not London. And when we pointed out that we had a partner in London and that I was spending 10% of my year in London, they said that doesn't matter. And the Silver Institute said, yes, we'll sponsor it. So the World Silver Survey was created, and we didn't like the fact that it was just producers sponsoring it. And that came back to bite us because there was this constant pressure from the sponsors to be bullish and to skew our data to make the market look more positive than we felt it was. So after the first 5-year agreement, Silver Institute and CPM Group went our separate ways. We started taking sponsors for our silver survey that we were doing. And we went back, we got the silver users. COMEX was now part of the NYMEX and then became part of the CME Group. They were a sponsor from time to time. And we had refiners and smelters and industrial users and purveyors of precious metals investment products. We've always worked very hard to have a base of clients that is spread across the market that pay us to be right, not to be bullish, not to be bearish. And it's worked. So I'm not sure who they are, but they don't pay us commissions. So that's just like, you know, Bob, when you want to talk about something, you should know about it. When you want to criticize somebody, you ought to know about them before you criticize them, because that's an empty criticism. It's weird. Okay, here's another one. I've become a believer in trading gold too, because I really want to focus on the positive ones. But trading physical gold will not give you the returns projected simply because of the fees. So do you recommend ETFs, paper, gold? The returns mentioned here, paper, gold, and silver. Well, I've already answered this a little bit. These are physical and forwards. And forwards are paper, but they are paper on an unleveraged basis in this case. They're not projected. They're actual hypothetical returns that one could have received absent of transaction fees, which at 33% total return over 40 years, the transaction fees on 13 silver trades are actually pretty low. So they are absent those fees, but the fees are de minimis. It's really not a big issue. If you are buying gold or silver as a long-term investment, bullion is probably best. ETFs are good too, but they only came into being after the year 2000, 2004 for gold, 2007 for silver. If you want to trade gold, i.e. buy and sell with a shorter term basis or a short term basis, my personal preference is options. I think Carlos Sanchez, my partner who really manages a lot of the asset management and commodity management work, also prefers options. We use options, futures, and forwards, and ETFs. So there's a whole toolbox full of tools that investors who know what they're doing can use to invest in gold and silver on a shorter term basis. But those tools, you know, they're sharp or explosive. You have to really know how to use them if you want to not cut your fingers off or blow your head off. And the returns, as I say on the charts and tables, were for gold and silver physicals and forwards on an unleveraged basis. So yeah, and they're good. They're really good. And somebody else pointing out they are incredible, you know, and they're very good. And yes, we're happy and we're very proud of our performance. We're very proud of the fact that when we're bearish, we say sell, and when we're bullish, we say buy. And we're very proud of the fact that we got it right in 2000 and 2001 and said buy these things for a long-term basis. And we're very confounded by the people who keep saying that we are bears on gold and silver. We're bears because we're not unrealistic. We don't think gold's going to $10,000 anytime soon, and we don't think silver's going to $5,000 anytime soon. That's not being bearish, that's being realistic. Right? Next one. In the 90s, I was a brainwashed, long-only gold bug. CPM Group saved me from delusion. Thank you. I'm glad to hear that we were helpful. The key is always to do your homework. Study the markets. Don't believe the hype. Don't believe the nonsense. Listen to all sides of the market. You have these guys out there who don't know jack about the economy and monetary policy, criticizing the tens of thousands of economists and bankers and others who know about this stuff. You got to listen to both sides. You can really listen very briefly to the other side. When you're going to, I heard a guy criticize the OCC the other day for hiring somebody who understands banking because he worked at a major bank for a long, long time. That's just like total nonsense. What we should go find Tommy, the deaf, dumb, and blind boy from the Who's album, and make him in charge of derivatives at the OCC. That way, he's not corrupted by the idea of actually understanding derivatives markets. Yeah, that's not true. Oh, I'll go someplace else. You gotta avoid investing in beliefs. You've got to consider the personality, background, and character of those whose advice and insights you take. If a guy's been found to do corrupt things in the futures market, has been barred from life, from being in the futures industry, do you really want to listen to him? Do you trust him? Bank robbers trust each other, but other people don't trust bank robbers. Take profits. Hedge your profits as you go, but take those profits. Tom wrote, the irony of a special involvement from the BIS as they control the price by selling future contracts in an endless fashion. If that's true, it can drive all commodity prices to zero or negative. Does this ever make any sense to you, the proper disclosure on physical ounces on hand before any selling? Okay, first off, it's not ironic. That's not even real. The BIS doesn't trade gold futures. The BIS also has a lot of gold in its asset base. So it's not necessarily interested in seeing the gold price fall, because a higher gold price actually increases its assets and makes its life a lot more pleasant. Nor does it seek to drive the price of gold down or other commodities. Now, oil was a special thing, and oil actually did not go to zero or negative in April 2020. The April NYMEX futures contract went to zero because that was physical. That was a futures contract that was an active delivery month at the time. April was deliverable in April. That's sort of the way it works in a futures market. And there was not enough storage space in Cushing, Oklahoma, where West Texas Intermediate oil is stored. There was not enough oil space because we were 2 months into the global economic lockdown and people weren't using oil. Airplanes were not flying. Trucks were not driving. Ships were not moving on the sea. And you had a surfeit of oil because the oil producers hadn't cut back on their production fast enough, soon enough. And it backed up in Cushing and there was no storage. So active delivery in that month was negative. If you wanted to take delivery a month later in May or 3 months later in July, the price was positive, right? But you didn't have the storage space. Oil prices on a global basis for physical oil across geographic markets other than Cushing did not go negative. The forwards in May and other forward months didn't go negative. And to say that oil went negative in April is to suggest that you don't understand how the oil market works. Now, I don't think that disclosing one's position is proper, except in regulated markets where it's required. I'm sorry, I'm into privacy. Okay, I was saying that that you're saying a few months ago. I stopped getting generic silver and started buying silver coins and gold coins. And I think that's a great idea. One of the limitations we see with generic rounds, medallions, small bars, issued by non-government entities, it's great, and a lot of them are our clients, and I should be careful here, but you experience a far greater discount when it's time to sell them than you do with official government issued coins. And there are several reasons. There's a greater acceptability of official coins than there is of generic silver or gold. And official coins are more readily bought back, usually at a better price, usually without somebody saying, well, I need to have this assayed to see if it's really real. And there's usually less hassle and questioning. So yeah, sometimes you can get generic rounds more cheaply than you can official coins when you're buying. But when it comes time to sell, you can really run into some issues there. The numismatist said, wait a minute, now silver is an important investment? Very confusing, Jeff. You've been a vengeful bashing of it. And T-Bone said, you know what? He has not. He made a recommendation at $15 a few years ago and says it's going to $43. Thank you, T-Bone. But I have to tell you, we appreciate you coming to our defense all the time, but you're wasting your breath with the numismatist. He's made it clear that he's one of those people who will say untrue, offensive things simply for the purpose of saying untrue, offensive things, because he likes people to think he's either ornery or intelligent. One of my greatest quotes from Stalin is, he said he would get lists of people to be executed every week. And one day the list had Boris Pasternak, the author of Dr. Zhivago and a great poet in Russia. Boris was on the list. Stalin crossed off his line and said, don't waste your bullet on a dreamer. That is great. T-Bone, don't waste your words and thoughts and efforts on a loser. Okay? I'm sorry, but that's what it is. Jeff Stir, what's going on in copper? We thought we were going to need it for electrification. First off, Jeff Stir, it's 1980. I have grown my hair longer, but no, we haven't moved back in time. It's Jeff, okay, or Jeffrey, or Mr. Christian. But here's the answer. If you've listened to us and understood what we've been saying ad nauseum for the past 2 years as the energy transition and energy metals hoopla forward, we have repeatedly said that market hypesters have overstated how much copper will be needed and how soon it will be needed because they are overestimating how fast the move to electrification will happen. Yes, we're going to need a lot of copper. They've also underestimated the amount of copper that's out there, both in scrap that can be refined and in below ground reserves and resources that can be mined, smelted, and refined. So we are long-term kind of positive on copper, but we have been saying ad nauseum, if people listen, that the copper hype was overdone. So no, I'm not surprised that long-term demand 10, 20 years from now is not supporting copper prices in a situation where real economic activity has gone down to basically zero. Jeff, if commodity markets do not settle most trades with delivery, explain how there is no possibility for speculation and manipulation. I have no idea what that means. I just don't have any idea what that means. I don't watch CNBC. I don't answer for Jeff Curry. I don't even talk to Jeff Curry. If I had to guess what Jim Gardner was writing about, I think he would say, just don't know. I think there's some words here that if commodity markets do not settle most trades for delivery, then explain how there is a possibility of speculation or manipulation. But, you know, there's a disconnect there. There is the fact that markets trade back and forth, and not just commodity markets, financial markets, stocks and bonds trade back and forth between the time they're issued and the time that there's an ultimate owner who never sells them again. So the idea that most trades are not in the commodities market are not settled with a physical delivery is representative of the fact that these are financial markets used by hedgers and investors. The possibility of speculation and manipulation has existed forever across markets, even in the absence of futures and options. And people will try to manipulate markets forever. And speculation is not necessarily a dirty word. We try not to use it. We talk about short-term investors. And we worked with governments who say, okay, we don't want our people to take foreign exchange out of the country for speculation purposes, but they can take money out of the country for investment purposes. So there are governments that say, if you want to invest in COMEX silver, you may take money out of the country and invest it in COMEX silver futures or options contracts. But if you want to speculate on COMEX, then you may not take the money out of the country. And then somebody says, well, let's say that I think that silver is going to $43 in 2025, the way CPM Group talks about it. And so I say, I want to invest in silver on the COMEX because I think it's going to $43 in the next 2 or 3 years. Government says, okay, that's an investment. Put the money, take the money out, invest in COMEX. The next day, the price goes to $43. Just been wrong. I take my profits. The government now comes back and says, hey, that was a speculation. You lied to us. Yeah. So we try to avoid the word speculation. They're short-term investors and there are long-term investors. And speculation is not bad. I speculate all kinds of things like, am I going to be able to get out of here in time to go play tennis this afternoon? That's a speculation. I'd hate to see the Supreme Court rule that I can't do that anymore. I think that's what you're talking about. And it's just like there's a non sequitur, there's a disconnect. You know, the fact that markets don't deliver all of their contracts has very little to do with speculation and manipulation. So, and if you want to know what Jeff Curry thinks, ask him. A couple housekeeping items. We will be having our Platinum Group Metals briefing on July 26th. That coincides with the release of our 2022 Platinum Group Metals yearbook. And by the way, I don't know how many people have written to us, you know, I'm a gold investor, I'm a silver investor, I would listen to you guys, I love your videos, but you know, I can't afford a $160 gold yearbook. Well, if you can't afford a $160 gold yearbook, you probably can't afford an ounce of gold. To be fair to smaller investors, we've had institutional investors come to us for 40 years. Well, we've only been in business 36 years and say, oh, I'm thinking of putting $100 or $400 million into a mine to produce the X, Y, or Z metal. And I would like a long-term study and consulting program with CPM Group on that metal. And we say, okay, maybe it's $40,000, maybe it's $60,000, maybe it's $80,000. They say, I'm going to pay $40,000. I mean, I'm thinking of investing $400 million in a company that may produce a metal that no one ever wants, and I may lose $400 million, but I am not going to spend $40,000 to find out if I should or should not make that investment. One of the world's largest and best hedge funds had a guy who was running its metals division back in the period 2000 up until 2009. And he bought reports from us at the time on lithium, titanium, tungsten, and vanadium. And in each case, we helped convince him that the investments during that commodity super cycle from 2007 to 2009 were bad investments. And he didn't make them. And the companies never moved forward, all of them. And he was fired because he had been hired to invest in mining companies, not to invest wisely in mining companies. So it's not just the smaller investor who says $160 for a book that tells me everything I need to know about silver so I don't keep making the same stupid mistakes that, you know, that guy or that other guy or that other guy tell me on the internet for free. I can't afford $160 in order to avoid losing all of my wealth. You're in good company. Some of the biggest and best hedge funds make the same mistake. I also want to invite everyone to attend the Silver Symposium in August. It'll be the second Silver Symposium. Stock Plus created the Silver Symposium last year. We participated. It was in Coeur d'Alene. They've moved it to Spokane, Spokane, Washington. It's out at the airport, 30th and 31st of August. CPM Group has an agreement with Stock Plus that we're going to try to help them beef up the thing wherever possible. I will be giving a speech on the real silver market. We will be hosting an open forum luncheon where people can ask us questions and answers. Stock Plus Pulse has assured us that they will do everything they can to make sure that internet personalities don't embarrass themselves the way that one of them did last year. It's unfortunate. We're talking about doing some other things that would give those people an opportunity to ask questions in a reasonable, professional way. But if they can't do that, we'd rather take questions from individual investors. And then we're talking with Stock Pulse about an evening presentation and discussion on the evidence for and against silver conspiracy theories. It's a program that we've done for years for mining companies, hedge funds, governments, and others. And we're thinking that we might make an abbreviated presentation and then open it up for question and answers. So please, we invite you to come to the Silver Symposium. We will be getting an Eventbrite URL from Stock Pulse, which hopefully we'll be able to give you by Friday of this week. 30th, 31st of August, Spokane's a beautiful place. We hope to see you there. In the meantime, you can go to our website, read our stuff, and invest $160 in a yearbook that's going to help you invest much more wisely going forward. Sorry if I went on long, but hey, there's a lot to talk about here. I'll talk to you Friday. In the meantime, take care of yourself, those around you, and the world at large, because the world at large needs your help.